This is More Knowledge, More Wealth with your host, Gabriel Shahin. Gabriel is a certified financial planner and a registered investment advisor at Falcon Wealth Planning. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the services or securities discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. Now here's your host, Gabriel Shahin.
Good day, this is Gabriel Shahin, Certified Financial Planner and your host of More Knowledge, More Wealth, here on every weekend, talking about all important topics of personal finance. My job is to go over the knowledge you need to increase your wealth. Now, to the listener, you can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short. Where you can go in our Knowledge Center, which gives you a direct link to YouTube, where we've had well over 1 million views, multiple videos that help answer the questions that you have. And if you want to put an inquiry so we can talk about it on the show or create a Knowledge Center video, please send your inquiry to radio@falconwp.com. That's radio@falconwp.com. And also you can go get this episode, any one of our previous episodes on Spotify, podcasts, you name it, folks. Now, I'm the president of Falcon Wealth Planning. We are a fee-only, non-commissioned, true fiduciary, folks. And we talk about all important topics of personal finance. That's where you are today, how retirement looks like, investments, estate planning, insurance, folks, you name it. Anything that involves a dollar sign, we can help you with. And we are offering 1 to 2 meetings, 1 to 2 hours of our time, folks, at no cost to help relate this show to your specific situation. And we have offices all across the country that we can help you with. Folks, give us a buzz. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, where we can help answer those questions that you have to help with your financial situation. Lots to go over today, folks. Appreciate you joining me. I wanted to go over just the political season starting here. There's always so much to talk about, always so much concern, so much fear, always a reason why you shouldn't be investing, always a reason to be worried about your portfolio and losing money. I get it. Everything out there is risky. But there's always a reward for taking on that risk. And when you take a look at just the annualized returns from 1929 to December of 2023, there's only been 3 presidents, all Republican for what it's worth, but seriously, 3 presidents that has had times of negative returns. And this is throughout their term, so it could be 4 years and so on. So the average return is 9.5% return since 1929. Now, when you look, and this is the S&P 500, right? Now, the market's done over 10% because remember, this is just doing it over the multiple presidents throughout this period. And so when you take a look at during the Great Depression, Herbert Hoover, yeah, he had negative average return of almost 30%. Not very good. I get it. And then, of course, FDR came in, and then Truman after that. Positive years, both of those over 10% returned. We had the roaring 40s after that. Then you had Eisenhower, same thing, over 10% returns. He was a Republican. Then you had 2 Democrats, JFK and Lyndon Johnson. Lyndon Johnson just at 10%, and of course Kennedy over that. Then you had Richard Nixon. Then you had Gerald Ford. Gerald Ford actually probably the best performing. He was a Republican. Nixon, another loss, probably of a maybe 1% loss during that period. Jimmy Carter, also. He was actually not bad, maybe close to 10%. Then you had Gerald Ford, we discussed. Jimmy Carter, Carter years, still 10% return. Even during those crazy inflationary periods, he still managed to get a decent return. Why? Well, because those inflationary periods. People forget times of inflation actually do perform well in markets. Let's continue. After Carter was Ronald Reagan. Yes, he outperformed Jimmy Carter, probably around the 12% annualized returns. Then you had Bush Sr., and then he actually outperformed Reagan. Then you have Bill Clinton. He was almost the best performer after Gerald Ford. Do people think about Gerald Ford being a revolutionary for doing fantastic market returns? Do people think about a booming economy when they talk about Gerald Ford? Anyway, Bill Clinton was good. The internet era fell right into that. Good for him. I remember when his Al Gore saying he invented the internet because he signed a bill to put money towards that. Then you had Bush Jr., W. Bush that is, and he had another year, yet again, third Republican, with negative returns. It looks like it was probably about a negative 2% throughout his time frame. Why? Because 2001, 2002, he came into office in about 2001, and what that happened, he right in the middle of the dot-com bubble, he was there, started off with negative double-digit returns in the S&P 500, then boom, he got smacked with the Great Recession of 2008, housing crisis, financial crisis. It was a crisis. Heck, I remember we were literally thinking that the government may be shut down. I mean, it's funny how sometimes I talk to people and they're saying, oh, just invest in the S&P 500 and nothing else. I sold out of these stocks. I sold out of this portfolio. I sold out of, forget diversification. You'll die with diversification. I'm putting 50% of my money in the S&P 500 and 50% in information technology, tech companies, whatever the case is, NASDAQ. And it's just like, wow. These people on TikToks and Twitters with hundreds of thousands of followers, I'm thinking, I message them with no shame. I go, you must be under 40. Or if you're under 50, you probably didn't have as much money back then from 2000 to 2009. Why do I bring this up? As I go over W. Bush here, and I see how he lost money during his presidency. Remember, he was back-to-back 8 years in office. Well, because when you look at that 10-year period, the S&P 500 during that 10-year period lost 10%. Think about that. You have $1 million. You invested for 10 years. And now you only have 900,000. Can you imagine? You know, they talk about this 4% rule. Can you imagine withdrawing 40,000 a year, right? You started with $1 million. For 10 years, that's $400,000 over 10 years. And now you only have 500,000 left? That's the annoying part of not being diversified. You live and die by the performance of one asset class, one economy, one government. It's madness. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth here, and every weekend talking about all important topics of personal finance. And I'm just talking about the basic concepts of investing and the political season. We've already experienced some volatility. All right, month of September, we're visioning maybe October will also get some volatility. It's very normal for a 10% pullback to happen. We shall see. But when I look at George W. Bush, and I see people saying you should just buy S&P 500, and I see his return numbers during a very bad 10-year history, arguably the worst 10-year history since the Great Depression. And people blame this on what? On the president? A lot of this was inherited. I mean, you take a look at even Obama after that, yet again over 10% returns. Trump actually outperformed Obama and Joe Biden. Are we over here saying Republicans are better than Democrats? The only 3 times it happened where the market lost money during someone's presidency, all 3 of them were Republicans. And people are saying Republicans are better for the market. Now, I get it. I can see it. Part of it, if you just took out the Great Depression, I could see why they say that. But quite frankly, who cares? The market could care less who president is. Let's just say they raise corporate taxes, whether it's Republican or Democrat. Historically speaking, a Democrat would raise it. The corporations don't care about a corporate tax. They're just going to raise their cost on you. It's another form of inflation. They call it fiscal policy. We've talked about this a while back. But when you take a look at who's going to be president, sure, there is a social, economic issue that happens. People get uncomfortable. People don't like what's happening in our borders, in our schools. People don't like certain initiatives that are going on. I get it. It makes you feel uncomfortable. I'm just saying from a money point of view, chill. Don't let the emotions get involved with money. Don't let politics involve and make decisions, poor decisions based on money. As Warren Buffett says, you never mix politics and investing. You just don't. It makes no sense. There's nothing good that can come from that at all. And I see it far too often. And when you look at the returns from during and after election periods, you're looking at 85% of the time the markets are still up. It literally doesn't matter. Average returns, yet again, since 1929-2023, you're looking at 10.67 returns. 10.67%, the average return year of the subsequent to an election, versus 11.57, higher by almost 1%, versus average return during a U.S. election year. It's actually volatility is your friend. And when you take a look at that, outside of the 2008 Obama and McCain, where it was absolutely just disastrous, I would be curious what the return numbers are without that. It's much higher, but you can't cherry pick. You have to take a look at everything that's available out there to make a decision. And all I'm just saying is, so many people get caught up in the emotional piece to investing, and they focus too much on what's good now. For example, international hasn't been good for a while. I would say I'm more bullish on international. That's just not Gabriel Shahin. That's just not Falcon Wealth. You have some of the largest, almost all the largest money managers in the country, arguably the world, whether it's BlackRock, whether it's Fidelity, whether it's Vanguard, whether it's Dimensional. They're saying over the next 10 years, international will outperform U.S. Well, they said that at late 2022. Well, what happened in 2023? The U.S. substantially outperformed international again. So you got these people that are on their iPhones recording themselves on these blogs, and they're talking about key elements of how you should be investing, and oh, by the way, how you should only be in the S&P 500, forget anything else. Yet again, it's one asset class. They haven't experienced a 10-year period where they've lost money. Talk about a punch in the face. What a terrible investment. And are you willing to do that with your life savings? Now, if your life savings, like these people on their TikToks, are telling you only invest in the S&P 500, if they're over here telling you to do that and they only have $20,000, well, a 30-40% drop for them is nothing crazy. It's not their life savings. They're probably in their 40s. And they're really smart. They sound smart. But they haven't experienced anything. And proof of that is, what answer could they possibly give for what and how you should have invested from 2000 to 2009? There is no answer they can give because they don't know. And that's where you have to reassess your situation and the information that you're getting. You're listening to smart people with zero experience. Is that where you want to put all your money? Listen, put your money in the S&P 500. I agree. What do they talk about? VTI, VOO, SPY. I get it. All that makes sense. I respect you. But once you start to have over $25,000, you probably should diversify out a little bit more. And again at $100,000, and again at $1 million, and again at $10 million. It doesn't stop. You can't do the same redundancy that you've done in the past. You have to be more fluid with what's going on. Interest rates change. That affects certain sectors. Political issues are coming up. That can affect defense companies. You can't, recessionary periods, there are defensive stocks that are out there. High interest rate and lower interest rate environments, certain industries benefit from that. This is where it's important to talk to a financial professional. We would love to help folks. We're offering 1 to 2 meetings, 1 to 2 hours of our time, folks, at no cost. Give us a call. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, where we can help relate the show to your specific situation. Because there is no shortage of information out there. But the people that are out there, they're trying to sound smart. They're trying to get you to click, because they get paid for that. They want you to subscribe. And lastly, seriously, when they get it wrong, they're going to pivot. Oh, you're still doing that? Well, I had episode 177 where I said, oh, you shouldn't do that anymore. I have never in my career steered away from being globally diversified in your investments. It has been tested through time where it is, when I say bulletproof, I'm not saying you can't lose. People who've gotten shot with a bulletproof vest still has a welt there and get hurt. Sometimes it even punctures a little bit and it draws blood, but it will save your life. And being diversified, you put all your eggs not in one basket, but you put, let's just say, the dozen eggs, each egg in a different basket. How about 12 baskets for 12 eggs? So if one cracks, you still got 11 more. Folks, we're going to go on a quick break, and when we come back, we're going to talk more about what to expect in the volatility in the second half of the year, actually last quarter of the year, and then we're going to talk about steps of how you should bulletproof your portfolio. We'll be right back after a few words.
This is Gabriel Shahin, Certified Financial Planner and President of Falcon Wealth Planning. We wanted to offer you a free financial assessment for listening to the show so you can help relate it to your specific situation. We offer multiple services such as retirement planning, where you are today, how retirement looks like, talking about Social Security, real estate, planning, even if you own a business, talking about taxes, not just how to save money today, but also throughout retirement. Talk about investments, making sure you're avoiding those high fees, costs, commissions, and also estate planning and insurance, just making sure you're properly protected if, God forbid, something were to happen. And we're offering 1 to 2 meetings, 1 to 2 hours of our time at no cost. Give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, and fill out the form fill right there on our site. We would love to help you in your financial situation. We look forward to serving you.
Welcome back, folks. This is Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth, here on every weekend, talking about all important topics of personal finance. And today we're just talking about the volatility that's happening, and really just, quite frankly, talk about the election season coming up, because with the debates coming around and with all this hoo-ha going around, and people feel they know for sure they're going to vote for one and can't even fathom voting for the other, whoever that may be. Whether it's people that are pro-Harris and anti-Trump, or pro-Trump and anti-Harris. I get it. There's some things that you're not going to like if one or the other gets elected. But from an economic point of view, I always say chill. Calm down. Because companies are going to find a way to monetize what's pissing you off. Or they're going to find a way to monetize what makes you happy. That's what marketing does, right? They try to motivate you to put your money to work. They try to motivate you to find a reason and find a way that you are consistently doing what they want you to do, which is to buy, to motivate you, to pull those strings on your heart, to do a call to action, to pick up the phone and call, or to get you hungry, say, ooh, that looks really good. You know what? I know I have leftovers, but that pizza sure feels good on a Monday night football game, or a Sunday night football game, or whatever football game is coming on. So the idea is diversify your investments. Why would you put all your liquid money into an S&P 500 fund? And I talked earlier about each president, how they have done, and majority of them have successfully done well. They've outperformed what you see today, the S&P 500. They've gotten those S&P 500 returns. But when you look and you exclude some of those bad years, the performance is 11.5%. And this is as of the end of 2023. So you're going to want to make sure you're able to participate always. I almost want you to lose money. Not like forever, right? Like you lose it. Losing is a loose term. I want you to participate in the volatility of the markets, because by doing that, if it drops and if you manage it properly, or you work with somebody that manages it properly, you're buying on sale. And you need those drops where the average investor does better than the average fund returns. Why? Because you're buying when it's low. And I see people that say it all the time, but boy, oh boy, they freak out when they lose a lot of money. I'm here to tell you, don't worry about it. Have a plan. And stay invested, not just in stocks. Now, depending on your age, right? These 40-year-olds who are telling you to put all in the S&P 500, they're not even thinking about retirement. But bonds are important in a portfolio because you may think, like some of these people that say I have $2 million at 42 years old and retired and all their money's in the S&P 500, everything's great until it's not. And when the market is down, and let's just say they're pulling $80,000 a year, 4% on $2 million. Let's just say that's the case, okay? Well, now their portfolio of $2 million is $1.3 million because of a 35% market drop. And now they're still pulling $80,000 out. That's no longer a 4% distribution. So they're now pushing on 6-7%. And the issue with that is that may not be sustainable. You know, the market, it took 18 months from the market high to the market drop. Then it took another almost 3 years to rebound to where it was. That's almost 5 years from the top. So the idea is what? What are you going to do to enhance your situation? Because when you look at even the bond returns, throughout that period of time, where you look at the average return year subsequent to an election, it's 7.33%. And the average return during a U.S. election year is 6.84 for the normal bond index, the Bloomberg U.S. Aggregated Bond Index. We call it the AG. And so when you look at the Biden versus Trump in 2020, yeah, sure, the markets, bonds lost money. Same with Obama versus Romney in 2012. But outside of that, especially the Carter versus Ford years, this is from 1976 to 2023, you had rates almost 20%. And people forget, when you in 1984, Reagan versus Mondale, that it was over 20% in the 84 elections. Like, volatility is normal, but when you look at the stability where you've only had 2 periods of time during the election years where it was Biden versus Trump, and then you had Obama versus Romney, where bonds actually performed positive. And historically speaking, bond returns have well over a 3 times better performance than money market rates. And historically speaking, it's much more stable, not as volatile. Yet again, just another commentary why your portfolio should be reanalyzed. It should be relooked at. I mean, they call it almost like a checkup, right? Or they call it a midlife crisis. I'm calling it a midlife checkup. You should be doing a midlife checkup of your situation, especially what's going on in the market. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, certified financial planner and your host of More Knowledge, More Wealth, here on every weekend, talking about all important topics of personal finance. And I'm just talking about the volatility that has happened and that we're projected to see leading up to the election and even after the election. You know, it's funny, people thought it was terrible when Biden got elected, but the market soared after that. In 2016, they thought it was terrible when Trump won the election. Market soared after that. Same thing with Obama. I mean, it's just, at the end of the day, companies and economies, they want stability. And they want to be able to know how they're going to run their business if one party, or not even party, person gets in. But then what are you doing in your situation right now? Are you positioning yourself for success? Are you staying in one asset class? Are you diversified in multiple asset classes? Do you have fixed income in your portfolio, or are you sitting in cash? Because I'll tell you this, when interest rates start dropping, bond prices go up. Or are you still sitting in that 4 or 5% money market? And actually, banks are already ahead of the curve. We know the rates are coming down, and that's why you slowly seen market rates come down. I want to talk a little bit, switch gears, just about this, what did I call it? Retirement checkup. Or midlife checkup. How's that? So first off, you got to make sure, okay, the midlife checkup is you got to make sure you're properly allocated. You can't just have all your money in the Magnificent Seven or tech stocks or the S&P 500. Number two, you got to be prepared for market volatility. What does that mean? You have to know what you're going to buy and what you're going to sell. The only way to do that is if you're diversified or if you're sitting on a bunch of cash. Number three, rebalance your portfolio. I mean, consistently do it. How are you going to do that with S&P 500? There's only a certain amount of money that you can deploy into the markets if the markets keep dropping. Number 4, make sure that you understand how you're invested in short-term treasuries, short-term fixed income, or money markets. Those rates that you're enjoying are not going to be around forever. Government is reducing them. And number 5, a midlife checkup is taking a look at what you're investing in general. For example, I have seen people that are looking for more consistent income and so on. They are looking to maybe get into real estate. Now, why do I bring that up now? Well, as interest rates are dropping, you have to reanalyze every single asset class that you're in. Now, maybe you don't want to be in real estate. You don't want to be a landlord. I get that. I respect that. I mean, heck, you have one, if somebody moves out and you have to replace a kitchen, could be your whole year of profits in replacing that kitchen, or replacing a roof, a whole year of profits. You know what I mean? You just lost a year of cash flow if you have to put an $8,000 roof on. You might only be netting $1,000 a month if you're lucky. So assuming you had a grandfathered rate or whatever the case may be. But the idea I'm trying to share with you is when interest rates come down, all of a sudden prices of the homes become more affordable. Sure, they may appreciate depending on the region that you're in, which is a good reason real estate may be good, but also, the cap rate of your investment of real estate could be better. Because if the interest rate drops, the mortgage payment is less. Very rarely people just write a check and buy a property. Doesn't really work that way. They typically finance it. They're smart enough to do it. You were smart enough to do it when you bought your house. Let's just say you have a 2.5% interest rate. You're really in a rush to pay that off? Why? I just said you can get 4 to 5% in a money market. What benefit or incentive does that give you? Nothing. So please be strategic on the things that you do. And if you don't, talk to a professional who is. Because a true financial planner, somebody that partners with you, their job is to make sure they can enhance your overall net worth. Are other planners talking about buying real estate? No, they're probably talking about selling your real estate in a REIT fund that you've probably heard about in a free dinner seminar where they're getting a 10% commission on. You get what I'm saying? These are the issues that I consistently see. And all I'm trying to tell you is be on the lookout, be proactive, and understand volatility is normal. And it's underway, and we're starting to see it. So instead of being fearful, selling where the market is right now and not knowing when to enter because the market may go up afterwards like it's done over the past few elections, stay invested, stay diversified, stay ready to buy and sell. And if you need help with that, give us a call. That's why we're offering a free financial assessment where we're giving 1 to 2 meetings, 1 to 2 hours of our time at no cost, folks. It doesn't matter where you're located. We'd love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website at falconwealthplanning.com. That's falconwp.com for short.
That was a fast show, folks. I want to thank you for tuning in with us this weekend. You can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can go and visit our Knowledge Center, which redirects you to YouTube. We have over 1 million views, folks. And if you want us to discuss anything on YouTube, on the show, whatever, send your inquiry to radio@falconwp.com. That's radio@falconwp.com. And if you want this episode, any one of our previous episodes, you can go on podcast, Spotify. We have them all there. And folks, we want to thank you for your trust. We want you to feel free and feel comfortable to reach out with any questions that you have. Have a great week, and God bless.